Happy day everyone. Welcome to today's video lecturing. In this session, we'll be discussing about traditional approach in capital structure. Let's begin. What do you understand by the term financial management? Financial management is concerned with planning effectively the economic important resource, which is capital fund. Capital fund is the composition of large sources such as long-term borrowings, preference share capital, equity share capital, which also includes the retained earnings. All this is referred as capital structure. The total capital structure of the firm is divided into two, which is equity capital, which consists equity share capital, preference share capital and retained earnings, wherein debt capital includes long-term borrowings, debentures, public deposits, bonds, etc. A company can have different pattern of capital structure. It can be of only equity share or equity and preference shares, or it could be in a combination of equity shares and debenture, or also they can have combination of all these three in their capital structure. The capital structure of the firm should be examined in a way in which it contributes maximum towards the value of the organization. So, in that regards, there are four theories are available, namely net income approach, net operating income approach, traditional approach and approach. For these theories, there are some set of assumptions to be followed. That assumptions are, there are only two sources of funds are used, which is equity share capital and debt. So, meaning to say preference share capital are not used, and the total asset of the firms are given and capital employed are constant in this regards. There is no change in the investment decision of the firm. There is no retained earnings, meaning to say that all the earnings are distributed to its shareholders in name of dividend. There is no corporate or personal taxes. The operating profit of the firms are given and not expected to grow. So, meaning to say that there is no loss as such. The firm is running only in the profit, and the business risk complexion of the firm is constant. So, these are the assumptions based on which the theories has been taken forward. Some basic notion used in the capital structures are: S denotes the total market value of the equity, wherein D denotes the total of debt, V denotes the total value of the firm, and I is interest, M.O.P is net operating income, N.P is net profit, KD denotes it as a cost of debt. What do you mean by cost of debt? The total interest expense owned on a debt is termed to be cost of debt. KE denotes cost of equity. What is cost of equity? So, the total dividend paid to its existing shareholder is termed to be cost of equity. Then it is KO. KO is termed to be cost of capital. A cost of capital is nothing but the cost incurred by the business to finance its operation. So, to finance the operation, the company is getting some kind of sources, which is they are using the debt and equity. So, for the debt, the company will have to make a payment as an interest. For equity, they'll have to pay dividend. This is termed to be the cost of capital. D not represent dividend paid, whereas D1 denotes that expected dividend to be paid in the upcoming years, whereas P not represent the current price of the shares, P1 refers the price to be paid in the future. Now, let's look into the traditional approach. First, let me briefly explain what is traditional approach. So, traditional approach takes the midway between the NI approach and NOI approach. What is NI approach? The value of the firm can be increased by increasing their leverage. The leverage is termed to be financial mix. The financial mix of debt and equity to increase the value of the firm. So, that is termed to be NI approach. Whereas in NOI approach, the value of the firm will remain constant irrespective of however we are increasing the financial leverage of the firm. So, the traditional approach is in between these two. Meaning to say, in this, a firm will be increasing its leverage to a certain limit. When the leverage has been increased, the value of the firm will also increase. But beyond a certain limit, it will not be applicable. So, beyond the limit, if we are keep on increasing the leverage, it will also increasing the cost of the capital. If the cost of capital is increased, which will decline the value of the firm. So, the capital structure, whenever we are designing the capital structure, it should be in a way where there is a proper usage of the debt and equity is being used to attain the optimal capital structure for the firm. So now let's see in detail. In traditional approach is classified into 3 stages. The first stage is termed to be increasing value. In this stage, the firm will be increasing its cost of equity and also it will be increasing the cost of debt. So it need not to be the same proportion. The cost of equity will be increased or it will remain constant, and the cost of debt will remain constant to up to a limit. So in this process, when we are increasing the proportion, it will also lead to an increased change in the value of the firm. The second stage is optimum value. In this optimum value, if we are going to increase the leverage beyond a limit, if you keep on increasing, that will have a negligible effect on the cost of capital. Meaning to say, if you keep on increasing the financial leverage, that will also start to increase the cost of capital. Up to a certain limit, the cost of capital will be minimum and the value of the firm will reach its optimum. If we keep on increasing the leverage, that will lead to a third stage, which is declining value. So beyond the limit, if we keep on increasing the composition of dividend and equity, that will also increase the cost of capital. If the cost of capital is beyond the limit, then the value of firm will start to decline, because I'll have to make a payment for the dividend. I'll have to make a payment for the interest. And I keep on making a payment, that will reduce my value of the firm, which will not increase beyond the level. Whenever I'm using the leverage, it should be in a proper composition to make sure that I'm obtaining or I'm reaching the maximum value of the firm. That should be kept in the mind. This is the graphical representation of all these stages. So in the stage 2, it states that the firm will attain its optimal capital structure. Thank you. Happy learning.